Hello, this is Chapter 13, Leverage and Capital Structure. This chapter covers the capital structure theory, which is related to the leverage of the firm. So, what is the capital structure? The definition of the capital structure is the percentage of debt and equity used to fund the firm's assets. So, we have in balance sheet, we have asset side. This is asset, and this is the debt financing, and this is equity financing, right? Then we know that assets should be the same, is debt plus equity from the accounting identity rule, which means that the firm's assets should be financed either through debt or equity, and capital structure is the proportion of debt and equity to acquire asset. So we use the word term leverage, and this is focusing on the use of debt. So if leverage is high, then that proportion is higher. So for some reason, if the firm needs to restructure the capitals, then there are a number of ways to do. Basically, there are two directions: increasing that leverage and decreasing leverage. Increasing leverage means we increase the proportion of debt, and decreasing leverage, we decrease the proportion of the debt. And how to increase leverage? We can issue debt and repurchase the outstanding shares, which is equity shares. So issuing debt increases the debt, repurchasing shares decreases the equity, then leverage increase. Opposite way, if we want to decrease the leverage, then we can issue new shares to increase the equity and retiring outstanding debt, so repay the debt, decreasing the outstanding debt amount, so we can decrease the leverage. So what is the relation between the capital structure and the shareholders' wealth? As you know, the primary goal of the financial managers is to maximizing shareholders' wealth. So shareholders, stockholders, so we try to maximize the firm value, which is the maximizing the stock price. So we try to maximize the stock price. To do so, we basically need to minimize R, which is the weighted average cost of capital. If we minimize the WACC, then we can maximize the stock price, because the WACC is the discount rate that we can use when we discount cash flow to the current. So the objective of the capital structure theory is we want to choose the optimal capital structure that will minimize WACC and maximize shareholders' wealth. So now try to see the effect of the financial leverage. If we increase the debt, what happens? Now the leverage, using that amplifies the variation of both EPS and the ROE. EPS is earnings per share, and ROE is the return on equity. Which means that if you increase the leverage, then the volatility of each, both EPS and the ROE actually increases. To simplify the problems, we'll ignore the effect of tax at this stage and see what happens if we increase the leverage. So this is what happened. Currently, we have $80 million asset and no debt. So this is unlevered firm, which is called the unlevered firm. So no leverage, 0%. So that equity ratio is a 0. And if the share price is $20, and the shares outstanding should be 400,000, because the total assets should be the $8 million, 20 times 400,000. And if the interest rate is 10% now, the proposed restructuring is instead of having all equity, we repurchase the $4 million equity using the newly issued debt $4 million. So increase that by $4 million, decrease the equity by $4 million. So 50-50, 50%, 50%, right? Which means that the equity ratio should be 1 here. Now the share price is $20 still, and we have 200,000 shares because we buy back the 200,000 shares, existing shares, to decrease the equity to 4 million. Still 10% interest. See what happened. Now, if we have to know that, and there are 3 scenarios, EBIT 500,000 recession, million expected, and 1.5 million expansion. And we don't have any interest expense because there's no debt. So net income is 500,000, 1 million, 1.5 million directly. So equity is $8 million. So we calculate the ROE, net income divided by the equity, which is 8 million. It's basically from 6.25% to 18.75%. Now we calculate earnings per share. So number of shares outstanding is 400,000, right? So net income divided by 400,000, then it's from 125 to 375. Now let's see the proposed capital structure. Now the increase that 4 million. So with EBIT, same, from 500,000 to 1.5 million from 3 scenarios, but we also have to pay interest because now we have $4 million debt and interest rate is 10%. So interest is 400,000, and it doesn't matter whether your EBIT is higher or lower, you basically have to pay this cost. So you pay 400,000, then your new net income is 100,000, 600,000, and 1.1 million. Then calculate the ROE. Now equity is the 4 million. So instead of 8 million, we divide by 4 million. Then it's from 2.5% to 27.5%. EPS, now we use the 200,000 number of shares outstanding as a denominator. And it's basically the net income divided by this 200,000. Then it's from 50 cents to 5.50. So the volatility variation is actually larger with leverage, not comparing with the unlevered firm. So the variability in ROE range currently, no debt 6.25 to 18.75, with debt 2.5 to 27.5. So variation is higher for proposed with that, basically. That's the with that. EPS same. Currently no debt, 125 to 375, with that 50 cents to 5.50. So the variability in both ROE and EPS increases if financial leverage increases. And what is the break-even EBIT? So break-even EBIT means what is the EBIT that makes EPS the same. So the EPS for no debt is EBIT divided by 400,000, which is the number of shares outstanding. Now, with that, EBIT minus 400,000 will be the net income because this is interest expense. And then decrease the number of shares outstanding by $200 million because we use that. If you solve this, then EPS will be $2, which means that, the EBIT is 800,000. That's the break-even EBIT. Which means that if the EBIT is higher than 800,000, now what happened is that with that, EPS is higher. If EBIT is less than 800,000, then EPS for without that is higher. So the break-even EPS is $2. We can show the graphics here. Here, like the with that is the purple, and the no that is the blue line. And the break-even point is $2 EPS with $800,000 EBIT. And this portion is a advantage to that. So if we increase the debt and if the EBIT is higher, then we have some benefit. But there's also disadvantage for that if we lose money. Our EBIT is less. So if we make more money, then that is beneficial. If we make less money, then that is less beneficial. So the conclusion of this example is now the effect of the leverage depends on EBIT. If EBIT is higher, then leverage is beneficial. If it is lower, then it's not beneficial. Now, under the expected scenario, leverage increase ROE and EPS, And shareholders are exposed to more risk with more leverage because it's more sensitive. ROE and EPS is more sensitive to change in EBIT because creditors basically just receive the fixed amount of money, which is $400,000, the interest expense, but shareholders should pay for it. So if EBIT is lower, then their cost is relatively higher.